All right, we're done with all the methods. Now let's talk about depreciation for tax reporting purposes. Okay, much like in inventory where you can choose to do one method for financial reporting and one method for tax reporting, same thing can go for long-term assets and depreciation. So again, many companies use accelerated depreciation for computing taxable income because it allows them to push back the tax that they have to pay. But for taxes, what we use what's called modified accelerated cost recovery systems, or what's called MACRS, MACRS. Okay, and what that does is it gives us the ability, a very easy ability to calculate how much we're going to have to, or how much we're going to depreciate. Therefore, calculating how much we're going to have to pay in taxes, taking it out of our net income. But there's a big thing about MACRS that's a huge benefit to us. Most kind of assets require accelerated depreciation, while allowing a few to use straight line. We're going to use this again for tax reporting purposes, but it's not acceptable for financial reporting purposes because it often spreads the cost over an arbitrary period and fails to estimate the salvage value. That's the biggest key to this, is that for tax reporting purposes, or let's take a step back. For financial reporting purposes, I have to keep up with my useful life and my salvage value. Because remember, that depreciable base, I can't go past that. So that's TAC minus salvage value. When it comes to taxes, I'm able to depreciate the entire TAC. I don't have to worry about the salvage value. So I get 100% of the cost of the asset. I'm able to depreciate for the purpose of taxes, which is really nice. Now, how do we use MACRS? Well, first we got to figure out what our arbitrary period is. It's not what we choose. It's we look at a schedule, we look at a table and find out what it is. And this is what the table looks like. A 3-year, 5-year, 7-year, 10-year, 15-year, and there's other properties in there, but these are the most common ones. And you just find out what you're looking for. So if you have a computer, then you look out there and see it's, okay, 5-year property. I know that I'm going to have to depreciate this over 5 years, or it is as a 5-year property. Once I have figured out what property is, then I look at another table, and this is what it looks like. So then I would say, okay, 5-year property column. Notice I'm going to depreciate it over 6 years. Why? Because the assumption is I didn't pay for it on January 1st. Everything pretty much up to this point has been January 1st, but that's not how it's going to happen. So we just kind of assume some kind of half-year convention. But I'm going to take my TAC and multiply it by the 20% in the first year, and then by the 32% in the second year, by the 19.2 in the third year, and so on and so forth. And I get the entire 100% being able to depreciate it for tax reporting purposes. So this chart makes it super easy. That is MACRS. So in the next one, we're going to talk about what happens when we have to change the estimates.